Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today on the show, we have JoAnne Feeney of Advisors Capital Management. She's a US-based fund manager, long only, and honestly, a money manager after my own heart. We talk about stocks you should buy, stocks that you should sell, stocks that I should sell, including some big losers in my portfolio. We had a lot of fun with a woman who I don't think many people have this kind of resume. She's an economist. She also spent years as a semiconductor analyst. I would venture to guess that nobody has that kind of combination. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. I started learning about investing in my 20s, but as a mom, I'm already thinking of ways to teach my kids about investing now. Here are 5 easy ways to help your children start investing. First, let's talk about an RESP. This is a registered education savings plan. It isn't just a savings account. You can actually invest the money in stocks, bonds, and ETFs. Plus, the government kicks in up to 20% through the Canada Education Savings Grant. That's additional money helping your children's investments grow faster. Now, the second is to open an informal trust account. In Canada, an in-trust for account is one of the simplest ways to start investing. It lets parents or guardians hold investments on behalf of their children until they're old enough to manage it themselves. You can set it up through our partner, BMO Investor Line. Visit bmo.com/online investing. Select Open an Account and indicate that you're completing the application on behalf of an individual investor to get started. With the BMO Investor Line platform, you get access to the investments you need to help your children's savings grow. Number 3, let them pick Canadian companies that they already know. Children love feeling connected to things that they're investing in. Help them understand that some of their favorite places to go, like the grocery store, are part of public companies they could be investing in. Number 4, set savings and investing challenges, and you can make this fun. Challenge your children to save and invest a portion of their birthday money or their allowance. You can match their contributions as an extra incentive. It's a hands-on way to teach them the value of money and patience. Now, number 5, make investing a monthly family habit. Pick one day a month to sit down and review their investments together. Talk about what's happening in the world, why prices change, and how long-term thinking beats short-term panic. It's a life skill that will pay off for decades. You don't need thousands of dollars to get started, just the willingness to take the first step. Start small, stay consistent, and watch your children grow into confident investors. JoAnne Feeney, thank you so much for joining me on the podcast.
Sure. Great to be with you, Amber.
Let's start by way of introducing yourself to the Canadian investing audience. What's your style? What do you look for in the portfolio?
Well, Amber, so we have several options for investors at Advisors Capital, and I manage a couple of different strategies. I manage our balanced strategy, which on the equity side is designed to be more conservative, filled with high-quality companies, diversified across sectors, a little bit more of a value tilt. But I also co-manage our growth strategy, which is obviously going to be a bit more aggressive. And still, though, it's growth at a reasonable price. We're not a hedge fund. We're not going for, grand slams. We're looking to build a diversified portfolio for clients that will deliver, growth over the long term, and also diversified, but looking for the big changers, in the global economy to, fill this portfolio strategy.
Okay, so that's interesting. You're kind of agnostic. You're not just value. You're not just growth. You're looking for opportunities in either category. And I just want to take a step back and take a look at the broad markets. We are within spitting distance of all-time highs for the S&P 500, despite, we can number them off: tariffs, war, inflation, interest rates, all kinds of concerns out there. Despite all that, I'm sure you get lots of questions about, JoAnne, why is the market so resilient here?
Yeah, and I think, Amber, people need to recognize that the market, as it's called, is really just a compilation of 500 or so companies. And today the S&P 500 is really dominated by the top 10 companies in that list because it's market capitalization weighted. And so the market, so to speak, is being pulled around by those top 10 companies. And those 10 companies are largely exposed to the big technology and consumer drivers. And so when you break it down, you do find that the S&P as a whole looks pretty highly valued. But if you remove those top 10 and look at the rest, it's much more attractive in terms of valuation. And then if you stratify it even more carefully, you'll find that there are plenty of value opportunities in the market. You just have to look for them.
It's interesting because I think we've been so used to USA all the way, whether you're a US only investor or even a global stock investor, you've just had to own US stocks. This year, for the first time in a while, we're seeing underperformance. How do you, like kind of a US long only fund manager, think about that?
Yeah, so there's a couple of things. There are a lot of things going on right now that lead to investors to realize that there are a lot of international stocks that have been undervalued for years. International has underperformed for a very long time. And given the geopolitical issues, tariff issues, as well as defense and sort of volatility in country relationships, there's been a move towards diversifying internationally. And we have a whole separate international team that builds internationally oriented portfolios. And they've been able to take advantage of that. By the way, in my strategies, in balanced and in growth, we have the opportunity to go anywhere. So we can put in international stocks as well. And it's really that issue, the tariff policies that this administration has floated, retracted, floated again, are potentially damaging to the U.S. economy. And so it makes a lot of sense at this point to be sure to have some international diversification in portfolios.
And does that mean you're looking at US stocks and maybe get the bulk of their revenues abroad? Like, can you find an international stock right in the US?
Yeah, well, one thing people should realize, and this has been a puzzle for a long time in the economics community. I'm an economist by training, so I had an academic career. And one of the puzzles that we all were working on, even decades ago, was the lack of international diversification in most Americans' portfolios. It doesn't make sense from a risk perspective or a risk versus return perspective. So it's been sort of a chronic problem of American investors and probably Canadian investors too, that they've been less than fully diversified. One way to get that diversification into portfolios without going international is to own some multinationals. So there's a lot of companies that are US based that have global sales. And, whether that's a General Mills, whether that's Coca-Cola, a McDonald's, there are plenty of companies out there. And then, of course, in the technology space as well. So there are ways to get that international exposure into portfolios without owning internationally domiciled stocks.
We're going to talk about so many of those stocks. It's funny you mentioned General Mills because today I think it's getting hit. I didn't realize it's trading at the lowest level since 2020. I guess people don't want their Lucky Charms.
Yeah, there have been a lot of headwinds to General Mills. It actually is a stock that we like. We do expect the headwinds to abate. There's a lot of issues. One is the GLP-1s. So there's a concern that people will, reduce the amount of snack food they consume. That's clearly a General Mills strength. And there's also the concern that consumers who are facing tighter and tighter budget constraints because of the past inflation, are trimming their grocery spending to some degree. Nevertheless, it is a very well-run company. It has a very attractive dividend yield. And so for the long-term investor, this could actually be a really good opportunity to put some of that stalwart into their portfolios.
Almost a 5% dividend yield trading at 13 times forward earnings. Yeah. So you talk about the market being expensive, and then you've got General Mills just hanging out there.
It's a good opportunity.
Okay, you're talking my language because I love stock picking more than I love macro, but I do want to take, and we're going to get into it, I promise, but I do want to take this opportunity because you said you're an economist by training, just to get you to weigh in on the interest rate environment. I mean, we're hearing from Jerome Powell this week, and he is being taken to task around why aren't you cutting interest rates? Obviously, we know that's what U.S. President Donald Trump would like. And Powell himself seemed to acknowledge, if it weren't for tariffs, maybe we wouldn't be cutting in July, but he does seem to be ruling it out for this summer. What should Powell be doing?
Exactly what he's doing. Exactly what he's doing. So the challenge is this. The Fed has a 2% inflation goal. That's their sort of, we want inflation to be roughly 2% on average over the long term. That degree of price stability is helpful for firms that want to plan, their borrowing, their expenditures. It's helpful for them in setting wage growth over time, right? Compensation plans. And it's helpful for consumers to know that their income now is going to be worth roughly the same next year and the year after and the year after. So the 2% goal is half of their mandate, right? Price stability. But the other half of the Federal Reserve's mandate is maximum employment. And so at this point in time, the Fed is in a very difficult position because, to reach lower inflation, they have had to raise interest rates and they have slowly begun to bring them down, but now they have to pause. And the reason they have to pause, even though inflation has come down considerably, they have to pause because the tariff policy that's being floated by this administration could push up prices in a way that makes those price increases not a one-time, hey, slap on a 30% tariff, this price goes up 30%, but a gradual increase, a little bit of a price increase here. Companies are going to try to wait and see if they can maybe absorb some of that tariff and a little bit lower margin, but maybe they won't, and then they'll raise prices in the future. The point is that tariffs, in theory, cause a one-time change in price level, but in practice are likely to cause higher inflation. And that's what the Fed is expecting to happen in sort of this summer and into the fall.
I'm so glad you brought that up because that is the fear that inflation is going to perk up because of tariffs. However, and this, for the last couple of months, inflation in the U.S. has been surprising to the downside. And I wonder if inflation hunting is kind of the new sport, just like recession hunting was for the last couple of years, looking for a recession. Because I'm looking at these companies' quarterly results, and you are too, JoAnne, and I don't see a consumer. We just talked about General Mills. They're not even willing to pay for cereal right now. I don't see the kind of ability of these companies, the way they had coming out of the pandemic, to raise prices on these consumers. So in some ways, is this just going to come at the expense of margins, but not necessarily because these companies will eat those price increases versus pass it along?
Amber, that's exactly the question. It's almost, a way to think about this is as follows. If companies could have raised prices and increased their profit margins, they would have done that. So clearly companies recognize that the consumers' budgets are tight and there's a limited willingness or ability to pay more. But when you look at different companies, you recognize that there's different elasticities of demand among their consumer base. Philip Morris, for example, right? Tobacco products, highly inelastic demand. They're going to be able to push those price increases through to consumers. Other products have also less, maybe fewer substitutes for their products, and maybe they're more luxury items. And so they're appealing to a consumer base that does have more ability to pay. Nike, for example, right, has already announced price increases, some of which they're couching in, hey, it's a seasonal thing, we're raising prices. Others are more explicit about, hey, our material costs are going up because of tariffs and direct import costs. We're going to have to raise our prices. And there's a cachet to Nike to some degree that will allow them to pass those price increases on to consumers. On the other hand, there are going to be plenty of companies, maybe appealing to the lower end of the income distribution, that don't have a consumer base with the ability to pay a bit more. And they're going to have to eat those. And you're absolutely right. That means their profit margins are going to come down. But be aware that profit margins have been unusually high in the wake of the pandemic and all of those price increases. Prices tend to be sticky downward. In other words, firms will, once they raise prices, consumers get used to them, they're reluctant to push them down. So profit margins have been pretty high. So there's room for them to come down a little bit. But investors need to be aware of which companies are likely to see the biggest drops in profit margins and take that into account when they're figuring out how much they should be paying for such a company's stock.
You're so right. And we're going to talk about those nuances, but I want to kick this up to just the broad index, because how does this show up in the index? If we're in an environment where, yeah, maybe those profit margins can come down, they can normalize. When you're trading at 23 times earnings, 24 times earnings, which is what the S&P 500 is trading at, like, are those valuations going to be tolerant of profit margins coming down?
Yeah, it's tricky because, again, that S&P 500 is this compilation of 500 or so companies at the high end, which is pushing up the valuation, those top 10. They're in an area of the economy that's first of all less vulnerable to the tariff issue, right? These are infotech companies, companies like Amazon, which does have a retail component, obviously, but Amazon Web Services and the growth there is really what's driving that valuation and is likely to continue to push up their margins. So for those companies at the high end, their margins are likely pretty protected, pretty, invulnerable to the tariff issue. It's really in the middle and the low end that you have to watch. So when you look at outside of the top 10, the S&P 500 is trading at about 17 times. Not cheap, but not particularly expensive. And the way you see it, to answer your question, Amber, how are we going to see this, is in those earnings forecasts for the S&P as a whole. And what we've seen are those earnings forecasts have actually been rising. So I think we have yet to see the pass-through effect of tariffs on margins. That's something that's going to be coming. And I think it's really going to be company by company as opposed to the whole index.
It sounds like you're remaining invested. You're buying. You see opportunities out there. You're maybe not trigger shy. How do you think about market vulnerabilities? Like what risks do you see on the horizon that would make you turn more cautious than you are?
Yeah, so I think investors need to recognize that there's a lot of uncertainty right now. So back to your earlier question on interest rates and the Fed. One part of their mandate is price stability. The other part is maximum employment. The tricky position relates to this question about risks, right? If tariffs come back, that pause that was put in place expires in a couple of weeks. If those high tariff rates that the administration floated on a country by country basis, if they come back in anything like the numbers that they were talking about back on so-called Liberation Day, that will cause a slowdown in economic growth. It will cause a lot of small businesses who source out of China for cheap manufacturing to basically fold. So I'm painting a pretty negative picture here. This is a risk. And then we would see potentially a lot more unemployment than we do now. That's a risk for overall economic activity that affects consumer companies. It affects the housing industry potentially in the US. And so the Fed would like to cut rates in that kind of a scenario, but higher inflation from those tariffs means that they should be raising rates. And so that's why nobody should be looking to the Fed to solve this problem. They're stuck in a position of not being able to change rates at all, because on the one hand, they should cut, on the other hand, they should raise. And so the risk for investors is that we get an economic slowdown that would mean lower sales, lower profits in a big chunk of the economy. Most of the economy, remember, is filled with companies that aren't in the S&P 500. But what happens to those companies affects the top 500 companies because that forms their demand. And so a big risk is an economic slowdown. A second risk, and that's one we're watching, and that has, by the way, informed how we construct our portfolios, the type of companies we put in there to try to diversify so that principal amounts for client portfolios will remain less volatile, even in the face of such a threat. But others are obviously global political, instability. Maybe this Iran, Israel, U.S. conflict has settled. Let's hope so. There are other sources of conflict around the world, though. Russia, Ukraine, China, potentially Taiwan. So there's still a lot of risk out there. And so investors do need, I think, to build portfolios that are diversified against those risks.
We're going to talk about those stocks, but you mentioned growth, like that is the key risk, of course, growth stalling. And I look at Atlanta Fed GDP now that's showing the next quarter's growth is 3.4%. And yes, that's down from their forecast of 4.5%, but that is still so robust. As an economist, like, how do you think about that those real-time indicators, like the Atlanta Fed? They put out this forecast, all the data that we've got up until this point, and they say, all right, it looks like the second quarter is tracking to be 3.4%. Do you put a lot of weight into that?
Yeah, they're doing a good job. I mean, they have a good model, and they're looking at the data as it comes in and they update it. That's why it's called GDP now. It's based on all the data that they're getting at that moment of time. But the reason why the 2Q GDP number is so high is because the Q1 GDP number was so low. And the reason for that is because in the US, imports surged in the first quarter as folks anticipated those higher tariffs. So they front ran the tariffs. That led imports to go up, and that's a negative to GDP. And so the GDP growth number was especially low in the first quarter. But in the second quarter, those imports dropped substantially once those tariffs came into place. And again, lower imports means higher GDP. And so that led to a very high 2Q GDP number. So really look at the whole, look at the 6 months, and then you see something more normal for a mature economy. It's really, though, for investors, the question is of the future. What are the next 6 months going to bring? And that ultimately depends on what these policies are, not just the trade policy, by the way, but here in the US, it's also the budget bill, right? We saw the House version. We're getting some indication of what the Senate version looks like. They're hoping to get something through by July 4th. But that could raise, it's anticipated that will raise the deficit, putting more upward pressure on long-term interest rates because more borrowing by the government. And that also has a negative effect on economic activity.
Yeah, I think investors are kind of like they're waiting. There was a little bit of a scare this year. It's like, okay, is this it? Is this the tantrum we're going to see in the bond market? And yield said, nope, we're going back down. And so that is that. I guess you would say we're kind of like in wait and see in that mode to just decide how big is the deficit going to be, where are the offsets going to be before investors freak out about it.
Yeah, well, I think what investors are learning, again, looking at both the House version and what we know of the Senate version, is that it's impossible to bring the budget into balance in this country without raising taxes. And this bill probably extends the 2017, 2018 tax cuts that Trump put through in his first term. And without that tax revenue, given the size of payments on Social Security, on defense, Medicare, Medicaid, there's just not enough places to cut. And so without raising taxes, you can't balance the budget. And of course, nobody wants to raise taxes. So deficit spending is going to grow. And again, it's going to put upward pressure on interest rates, which isn't terrifically good for equities, right? Higher discount rate on future earnings from those higher interest rates means that the present value of those earnings is lower, means that stock valuations tend to be lower. But everybody's anticipating that. At this point, that's in, I think, people's expectations.
All right, this is enough macro for me. Let's talk some stocks. Okay, our first question in the mailbag is about Nike. We talked about this a little bit off the top. What are JoAnne's thoughts on Nike? Does she expect tariffs to affect the bottom line? This one coming from Daryl in Richmond Hill. And full disclosure, I own this one and I bought it before it dropped another 30%.
So we don't own Nike. We actually sold it a long time ago in anticipation of their challenges. Sorry, Daryl. Their challenges in China. That was the main reason we sold it when we did, because of the fraught China-U.S. relations and how China was taking aim at U.S. companies. And then, in addition, the threat of tariffs. Clearly a big problem for NVIDIA, even though, as I said before, they do have some brand cachet and they can push through some price increases. But notice when you look at the details of what they've said, they're only going to try to push through price increases on their highest price sneakers, which makes sense because that's their luxury customer. They've got a lot of money to spend, but still the volume is something one has to worry about. So sorry, we're not owning it here. We're not tempted by the price drop to buy this stock.
Oh man, I was hoping, it would be a different answer. This is my favorite kind of stock. I love to see like a high quality stock that's found itself in disrepair, but it just seems like, in addition to tariffs, and then they lost their way before that, right? And they had to bring in that new CEO. So they were already kind of struggling when the market was good. And now the market's bad.
Yeah, it's a real challenge.
Okay, so here's another stock that I'd be tempted on, a high quality stock that's fallen in disrepair. It's UnitedHealth. Would you buy UnitedHealth after its big drop? Is it an opportunity? This one coming from Lisa on Instagram. And honestly, like we've detailed what's gone on at UnitedHealth. It's one issue after another, but the big issue is what are their practices when it comes to insurance and health coverage. It's been politicized, but also it's showing up in the business, and it lost 50% in value. The most influential Dow component lost 50% in value in the last 2 months.
Yeah, it's a tough one. It maybe is the answer. Obviously, in the United States, United Healthcare is a key player, and it will always be a key player. It clearly mismanaged their pricing of their insurance, and the mismatch was between the pricing of the insurance and the outlays for the coverage that they basically contracted for with their customers. That mismatch needs to be fixed, but they know what the problem is, and now with new leadership, one would expect that they will get this right. There is also the risk of potential investigations of their coverage practices. That's something harder to know about. It's a little bit of an unknowable. So you have to weigh the risk that you face something unknowable against the likelihood, the strong likelihood that they're going to fix their pricing, which they should be able to do without a problem. So it's certainly a tempting one.
These two stocks are interesting. Does your guest like credit card companies, Visa and Mastercard? This one coming from Josh in Oakville. And recently, these stocks have taken a bit of a hit because of concerns from cryptocurrency of all places. Since Circle went public, which is a stablecoin company, it issues USDC, which is a stablecoin backed by the US dollar. That's all a stablecoin is it's a crypto that's backed by a real world asset. But there's no third party involved. And I think that's where people freak out. Okay, are we going to need Visa and Mastercard if stablecoins are the new thing?
Yeah, so this is a really interesting question. It's obviously, but first of all, we do own Visa and Mastercard in different strategies. The reason for that is they own the rails, right, along which financial transactions occur. Now, there are some threats to that. Stablecoin may be a threat to that. Zelle may be a threat to that, right? Any way to avoid those fees that Visa and MasterCard charge for the use of their rails, so to speak, might be attractive to people, right? It's a 2.5% fee on Visa and MasterCard. And it's something, by the way, that retailers are giving you the option as a buyer, as a customer, to avoid. You can pay another way to avoid that 2.5% charge, or you can use your Visa or MasterCard. And so you might think, wow, okay, yeah, stablecoin might clearly take some business away. But the question is this: which stablecoin? Is the stablecoin you choose going to be around forever? Should you use the stablecoin issued by a store or a stablecoin issued by a larger entity that's maybe tied up with a bank or even now tied up with MasterCard? So there's a lot of questions still about whether use of stablecoin will become ubiquitous enough to really cut into their business. One thing that might stop it from doing so are the two benefits you as a customer get from using Visa or MasterCard. One is you get points, right? I use my card, I get points, I get to spend those points later on other stuff, on travel, whatever. But the other thing is you get help in the case of a fraudulent charge. If there's a fraudulent charge on a card you have, Visa and MasterCard will go and figure it out for you and reimburse you. Is a stablecoin entity going to do that for you? Which one? Is it reliable? Again, are they going to be around? Do they have the assets? And then the third question, and so that's going to keep folks using Visa and MasterCard. Third question is the stablecoin truly stable? We saw in the earlier iteration of stablecoins that some of those so-called stablecoins they have to be backed by some asset. They're supposed to be basically dollars sitting there for every dollar of so-called stablecoin. But we saw that some companies weren't transparent about what the assets were that were backing the so-called stablecoin. And that then created volatility in the value of stablecoins relative to the dollar. Now, that's something that regulation could help fix. And maybe that will happen over time. But that's a question. One has to be careful about what's actually backing the stablecoin. Are there really dollars or treasury bills behind those? Or is the company speculating? Because basically the stablecoin is a float business, right? You give them real dollars and they give you this stablecoin. What are they doing with the real dollars while you have the stablecoin? Well, they're investing them in something that earns interest. And obviously they might be tempted to invest in things with a higher yield. And those things with a higher yield may not be as liquid. They may not be as safe. And so, there's a temptation for the stablecoin guys to do things with that float that might put the value of the stablecoin at risk.
It's funny. I remember a quote years ago. I was listening to a talk and somebody said, if Visa and Mastercard came out after blockchain, everybody would be like, wow, I can call somebody. I can have some of my issues addressed. That's amazing. There's a middleman in this transaction versus, blockchain, which, it's very difficult to reverse. Of course, if you send it to the wrong address by one number, that's too bad. That's sort of irreversible. Yep. Or if you forget your password, all kinds of things. And
hacking may be an issue too, right?
Having said all that, I'm looking at Circle, which is up 700% since its IPO just a few weeks ago. Could there be some short-term noise and some, the stocks, Visa and Mastercard have already taken a hit. Like, do you as an investor, if you believe all the points that you said, do you need to maybe put up with a little bit of volatility while stable coins are kind of the new shiny thing?
Yeah, we try not to invest in new shiny things. Circle is a good example. Its valuation is really high relative to its cash flow and its cash flow potential. So not attractive to us at all. Now, there are times, right, when you're willing to put up with volatility. Certainly, we're willing to put up with volatility in our growth strategy and in our small and mid-cap strategy. But we want to see a more predictable earnings path based on fundamentals. It's hard to see that with Circle, given where the valuation is.
Okay, let's take a quick break because we've got another stock that I'm dying to know if it fits your criteria. We'll be right back. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. All right, our next question in the mailbag is Tesla. Shares have moved higher after its robotaxi launch. Is that justified? Would you buy at these levels, or is the stock just too volatile? This one coming from Kevin on Instagram.
Yeah, hey, Kevin. The Tesla story is a difficult one to parse as an investor because a lot of the stock price seems to be based not on the fundamentals of Tesla, but on other stuff, the politics of the CEO. And that makes the investment far more speculative and harder to pin down in terms of its risk than we would like to see. The other thing is if you look beyond that to the fundamentals, what you see is that Tesla's having a tough time making money on its core product. And it does make a lot of money still on those carbon credits. If you remember, for a while, carbon credits were the only source of profitability in the company. In the last quarter, I believe, it was the case that that the carbon credits once again were their main source of profitability, and they lost money on the cars themselves. So you look beyond the cars and you look to battery storage, and we've done some research there thinking that might have been a really good opportunity, but our digging reveals that the stability of those battery storage products is not good. They have a lot more fires than other battery storage technologies out there, like, say, Enphase. And so we're less enthusiastic about that side of the business, maybe coming up and becoming more important. So given the political overhang and that source of volatility, plus the difficulty of the car business, remember, for a while, Tesla was the only game in town in terms of electric vehicles, but there's now a ton of competition. And you look at China and BYD, for example, if ever that were allowed in this country, Tesla would really face challenges. But we're seeing it out of GM and other companies now. It's just not going to be the only game in town. And so for them to support the valuation they have, they would have to ramp up cars so much and really dominate the market in a way that just seems unrealistic. So we're not enthusiastic about Tesla.
And to your point about the fundamentals, like we just got a read of their sales in Europe, whether it's a consequence of the politics, they dropped. In Europe loves EVs, right? They're all in on EV adoption, and sales dropped 30%. That's the fifth month in a row that they're falling. Having said that, people like to get excited about that new shiny thing that Tesla's going to come out with. And this time it's robo-taxis. It sounds like you don't and you can double your money on that kind of excitement, right? It sounds like you don't let that tempt you.
Yeah, you got to. I think it's really important to be disciplined and not get captured by the shiny new thing. And by the way, if you look at AI capabilities and self-driving cars, there are still just so many challenges. Notice they're doing their robo-taxi rollout in Austin, Texas, where it's generally sunny all the time, and their roads are pretty wide, and they can see the obstructions, right? Imagine trying to do this in Michigan or New York City or Boston, where there's just chaos and narrow streets and cars parked and double parked and people on bicycles, although there are plenty of people on bicycles in Austin. But there's just so much computation and so much learning that still needs to be done to support self-driving cars. We just think that's much further into the future than people realize. Trucks on highways, that's a different story. Start a truck off at the beginning of a highway in California, stay on the highway all the way across to the end in New York, that works. But city driving where taxis are used, I think it's going to be extremely challenging in any but, the sunniest, calmest, most organized cities, whether it be in Arizona or a place like Austin, Texas.
Toronto, yeah, that's even... I would love to see even the best AI navigate those streets at times. Let's go to another question. We've got one from Rich on the defense sector, and this one's super interesting considering this week. It's a big feather in the cap of Donald Trump getting all NATO members to agree to spending to 5% of their GDP on defense, including Canada, which is the biggest increase in spending since the Second World War. So that effort is happening. The defense stocks sort of knew that, right? And they have been such a bright spot, particularly in Europe. How do you think about the defense sector and whether, was all of this priced in? Does it wobble here? I think it was Citi this week cut the sector to sell, saying, this is probably as good as it gets.
Maybe. I mean, if you're betting on peace breaking out, then yeah, this is as good as it gets. If you think that there's always going to be a risk of global instability, violent instability, then you want to own defense stocks in your portfolio, if for nothing else, than to provide a cushion when bad things happen and other stocks fall, right? And that's an important role in a portfolio. So we've owned a handful in each portfolio. Whether it's a Lockheed Martin or a smaller company like Kratos, which is in the drone business, and other sort of low-cost engines business. The opportunity, I think, is still a strong one. The fact that NATO recognizes, I think, that they can't rely on the United States for their defense, right, and Canada as well, has pushed up their spending plans. And that's been, that anticipation has been growing for the last several months since our election. In the U.S. And so now we're seeing it, formalize, which is, I think, a good thing for the security of Europe overall. And so, yeah, they've long been laggards in spending on their own defense, and it's good to see them catch up. Now, be aware that Europe tends to spend their defense money on their own defense companies, and there are some very good companies in Europe that have seen their valuations really increase on the heels of this. But, the U.S. has some capabilities, whether it's Raytheon and Lockheed Martin, that are simply not replicated by the European companies. And so we do think that owning, a company like Raytheon, Lockheed, or Kratos as a smaller option, or L3 Harris are very good things to own in your portfolio, given that we're likely to see a geopolitical risk stay elevated for quite a long time.
Kratos, because it's not a household name, is ticker KTOS, and that
Correct.
one has done very well. Lockheed, what's going on with Lockheed? It's down from its 2024 peak. It doesn't seem to have benefited as much from this trade.
Yeah, there were some concerns about some of its programs, Amber. There were some concerns about whether the federal government would change the mix of their spending on defense, moving away from sort of the traditional conventional weaponry and planes to sort of lighter, cheaper options. So that's basically been behind the decline there.
So, but it sounds like, maybe if you're looking for an opportunity, a name that hasn't run away from you, Lockheed would be one that you could take a look at.
Agreed. Yeah.
Okay, let's squeeze in a few more questions here. Intel, is there any hope? Another loser in my portfolio, JoAnne. I got tempted.
So sorry, Amber. So I was a semiconductor analyst for 10 years before I came to Advisors Capital 10 years ago. And so I saw sort of the heyday of Intel. And then I also saw their early threats that Advanced Micro Devices, AMD, was creating back in like 2004 or 5, that area. And once again, what we have seen from Intel is a big stumble. They had some leadership that did not sufficiently invest in technology. And Intel does two things. It designs chips and it also manufactures chips. AMD got out of the manufacturing business a long time ago. So they outsourced to Taiwan Semi or Samsung or whoever. Intel has tried to continue to do both, and they had the scale to do that. The problem was that Intel went down a path of manufacturing that ultimately proved not to work very well. And so that recipe that they had developed was very different from the one that Taiwan Semi used, or Samsung or IBM. And that recipe turned out did not allow them to make transistors, the element of the chip, small enough, fast enough, and low power enough to keep up with Taiwan Semi. And so they have been behind now for years in terms of that manufacturing recipe. And that means that the chips they make aren't as good. They're not as fast. They're not as low power. They tend to overheat. That has allowed AMD to go from 0%, virtually 0% market share in the server chip business to 40%. Massive loss for Intel because that's the high margin, high price chip. They've also been losing share to AMD in laptops and in desktops. And so Intel has not fixed this problem. They have not improved their recipe. And they fired the last CEO, Pat Gelsinger, who probably had the best chance of fixing the problem. But hey, he didn't do it fast enough, and the stock price didn't respond fast enough, and so they kicked him out, which was probably a mistake. But they have a pretty good guy in there now, and they need to fix the recipe. That's a big job. So, maybe if you hang on to your Intel for another 10 years, maybe they'll fix it. Maybe it'll be broken up. Maybe maybe they'll split off the design side and sell it. Maybe they'll split off the manufacturing side. There were some good rumors earlier that, hey, maybe they, create a joint venture with TSMC to do the manufacturing side. That would have been brilliant because the U.S. does need semiconductor manufacturing at the leading edge, and Intel is the closest to that. That's an American company that we have. And so there's a lot of reason, for Intel to succeed, at least politically. So we'll have to see. But, if you want to stick with your Intel shares, I think you might have a long wait. Unless, again, there's a sudden sale and split up of the company, that obviously can cause a quick surge in the stock price. But the opportunity cost you face by hanging on is that you're not investing in something else, which might do better.
That's a great perspective. I got lured in like a sucker on those headlines. I was like, maybe some value be unlocked. But for now, Intel remains what it's been good for the last couple of years, tax loss selling.
Right. It's always good for something.
It's always good for something. Okay, last question in the mailbag before we get to your pro picks. We got to talk about Target. It's so funny. We're talking about these markets at all-time highs, and we found no shortage of laggards out there, which is kind of good, right? If you're if you are looking for some of those opportunities. Target, I mean, just stack it up against a Walmart, a Costco. It has not, TJX, it just hasn't kept up.
Yeah, so Target, it's one that we own. So we have been also unpleasantly experiencing this decline. There's a couple things that happened with Target. So first of all, they made a mistake, I think it was 2 summers ago, where they went for the LGBTQ month with some apparel and other products that offended some people. And unfortunately, social media amplifies, right, things like that. And it got really amplified to such an extent that a lot of its customers and investors were turned off. And that was the first big problem. And once a store gets a reputation hit like that, it's going to take some time to recover. Whatever your political views and whatever you think of whether they should have been viewed as offensive or not, it doesn't matter what we think, right? What matters is what the shopping public thought and what the investor public thought. So that was a problem in that too.
Then they pulled back from it, right? And then there was
yeah, they definitely did.
And then there was backlash on them pulling back for the backlash. Then they were caught in this this situation.
Exactly. And then the second thing that happened is, first of all, it should be understood that Target is not Walmart, right? That they're not really that comparable because Target doesn't do as much grocery as Walmart does. Walmart does a massive amount of grocery in their business, but Target has a very small proportion of their sales that come from grocery. And so that means that a lot of their products are more discretionary. It's towels, it's pots and pans, it's clothing. And the discretionary side of the business, given their shopping, composition, it took more of a hit when budgets started to become tighter because of inflation. Whereas grocery held up pretty well. So that's why Walmart outpaces Target. The question you have to ask is, should I own Target now? And here we think the answer is yes. And the reason for that is that Target was smart in expanding their inventory before the tariffs were levied earlier this year. And so that was actually held against them. They were smart and they got their inventory on the cheap before tariffs set in. And even though we're hoping we don't get the bigger tariffs, remember that the tariffs we have on right now are really high. They're like 10%. They used to be less than 2%. So this is not a trivial change in the cost for a company like Target. So they were smart to build up their inventory. And we do think that creates a tailwind for Target in the second half of this year, particularly if more tariffs come back. We also think that they are likely to benefit if the economy does slow down, as people that used to shop, say at Nordstrom or Macy, want to find more, affordable kitchenware, houseware, that kind of stuff. They'll end up at Target because Target does have good quality and they have it at lower prices. And they, by the way, have a very attractive dividend right now.
Oh, what is it? What's the yield? Is it, and it's sustainable? You'd call it sustainable?
I'm not sure what the exact number is.
Let me see. It's 4.7. 4.7. Yeah, 4.7. That's good. And trading at 13 times.
Yeah.
Okay. So we did find a beaten up company that you would take a look at, JoAnne. We finally did. Okay, let's get into your pro picks, some of your high conviction ideas. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick, JoAnne, is TJX. So we talked about that. You own Target, but TJX, that has been a home run.
Yeah, so TJX is even better than Target in the sense of it being two things. One, it's popular. People love to go bargain hunting, whether it's at Marshall's or TJ Maxx or the home goods store. It offers not just sort of quality, but premium stuff. You can find Le Creuset, pans. You can find, Boss clothing. You can find Theory clothes. So you can go into one of the TJ Maxx brands stores and find really great product at low prices. So in terms of the ongoing, enthusiasm for shopping, that's something that's always been there. But if the economy does slow down, again, consumer budgets get a little tighter, you find folks like with Target, but even more so, shifting from Nordstrom and Macy's and going to find those same brands they would find there over at Target for a much more attractive price. The second aspect of the benefit of a slowdown for TJ Maxx is that the source of the stuff they sell is the excess inventory from stores like, Saks, Nordstrom, Macy's, and other high-end department stores and, individual brand name retailers. That excess inventory gets sold off at very low prices to companies like TJ Maxx and other off-brand retailers. And so they get a cheap source of goods and they get to sell them at a time when their traffic into the stores is rising. And so great opportunity. It's a great sort of recession play because both of those things happen at the same time. More foot traffic and they get a good supply of stuff to sell. So opportunity for investors to have something in their portfolio that not only has some solid growth in normal times, but is also a good buffer against recession.
Is it expensive? Is it too expensive? 27 times earnings?
I don't think so. I mean, think about where the market is. And even the market extracting the top 10, it's more expensive than those, but it's so resilient. That means that it's less volatile. And you're willing to pay, as an investor, you should be willing to pay extra for stocks that are less volatile, right?
Good perspective. Your second one, less of a household name, is Quest Diagnostics. Also a nice chart over the past year. It's up 17%. In 2025, it's outperformed the market. Diagnostic testing.
Yeah, it also has a decent dividend yield. And the reason why we like Quest Diagnostics is, it is one of two laboratory services providers, right? The other is LabCorp. And so if you get any blood work done, chances are your doctor's office is using Quest Diagnostics or LabCorp. So nice duopoly. The other option for lab work is potentially in-house stuff at hospitals, but that has been falling over time. And when you look at demographics, right? Baby boomers are all getting older, right? They're getting more lab work done, whether that's routine stuff at your annual visit or because you have some mystery ailment that needs to be investigated. So the demographics play very well into Quest, and it's also really impervious to the tariff risk that you face. So it's a good domestic play, not subject to tariffs, and it's really inelastic demand.
And it seems like the thing that's hitting the insurers, which is more people are going for testing,
exactly, is
actually quite beneficial to a Quest Diagnostics.
Yeah, it's definitely information that says, okay, yeah, the lab companies are going to be doing well, given how much we're seeing use of healthcare services.
You mentioned you spent the bulk of your career, or a lot of your career, as a semiconductor analyst. You've had a fascinating career, by the way. Economist, academia, semiconductors. I don't feel like there's a lot of semiconductor analyst economists out there. So it's been great. It's been great to get to know you. So your third pick is close to home because you are that semiconductor expert. It is Broadcom, ticker AVGO, and it's at an all-time high.
Yeah, so Broadcom is I've actually known this company. It was called Avago when they went public. I was a semiconductor analyst at the time, and I was at a small investment bank. We actually were part of the selling group, so we were part of the IPO. I've known them since before they went public. I've known Hock Tan for forever. The value of this company is the areas where they have become proficient. So what this company does is they pick a space, and by the way, Avago, right now Broadcom, was spun out of Hewlett Packard indirectly through Agilent. So they were the chip business behind Hewlett Packard way back when. They have a unique technology. It's not like Intel chips. These are an unusual type of chip, very hard to make, very human capital dependent. That is skills and knowledge, and they have the deepest knowledge. So that's why they're in the iPhone, the high-end iPhones with their particular technologies. But they went beyond that. And they built over time a really diversified company. They're in not just chips, they're in networking technology that Cisco buys and uses. They are now also doing cybersecurity. They're doing software of other types, enterprise software. And most recently, people may know them because they co-design chips for AI computation. So they are known to be a co-designer with Google for their specialized chips for running AI workloads in the data center. And they have been talking about this for the past several quarters, and it's really opened up a much larger market than what they had before. But that still leaves them, again, in every area in which they operate, they're either number one or number two in the market. They're not a high growth company in terms of their revenues, except now for this AI business. They like to be in moderate growth businesses where they are the leader or the second leader, and they have very high margins. Their CEO is the architect of this company. He's done several acquisitions over the last, I guess it's been 20 years now. And every time he buys a company, he has borrowed a lot of money, buys the company, and he pays down that debt faster than they guide for, faster than they tell you they're going to. And therefore, they deliver higher returns on those investments than people initially expected. And that's what's helped power the stock higher. It's a great example of a company that I like to use when people say, oh, I missed that one. I can't own that because look at how much it's gone up and it's at an all-time high. When I covered the stock as a semiconductor analyst, I think the stock was $20. And then I went to 35 and people said, oh, I missed it. And I would say, you haven't missed it yet. This is a company that's going to continue to grow. So be careful about avoiding stocks that are at highs if they have the fundamentals to continue to push growth and their market size higher over time.
It's been an absolute beast of a stock, joining the $1 trillion club in market cap. And it's not been a rising tide situation. The semiconductor index is actually down over the past year. And Broadcom is outperforming NVIDIA, which takes up a lot of oxygen, but hasn't performed as well as Broadcom.
It's important for investors to recognize at this point that there is a big growth driver globally, right? Everybody's talking about artificial intelligence, but I don't know that people fully appreciate that we're just at the early stages of the rollout of AI capabilities. There's survey work done by the U.S. Bureau, BLS, Bureau of Labor Statistics, that looks every couple of weeks and asks firms how much are they using AI. And that has gone from 0 to about 9% of survey recipients. And that's, therefore, we're just at the beginning. And we're seeing AI start to be used in service companies and software companies, in financials, right, to make their workers more productive, to make their products different and more capable. And so companies like Broadcom, NVIDIA, AMD, and then a lot of software companies are building the capabilities to do this, obviously at places like Microsoft and Amazon and Google. And so I think there's a lot still to come. And that growth engine is likely to be impervious to things like the tariff problem, right? Things like geopolitical risks. And that's why I think the S&P 500 is at an all-time high. It's because those companies and that future potential is dominating the market, right? Those top 10 companies, of which Broadcom is one, is dominating the growth potential. And so for the long-term investor, right, owning some of these companies, not to the extent that they're sitting in the S&P, I wouldn't own 8% or 7% of NVIDIA in your portfolio, right, or put your portfolio that much in any one company. But it is, I believe, the long-term growth of the global economy, and it's worth having some exposure to that.
What a great way to end the show, JoAnne. It's been an absolute pleasure to speak with you, learn about you, and get your take on the stock market.
You too, Amber. Always a pleasure to be with you.
That's JoAnne Feeney joining us. Make sure you tune into our next episode. We've got John Ewing on the show of Ewing Morris. They are known as activist investors, and they traffic in small and mid cap. One of their stocks just went private, got taken out, though they weren't super happy about it. And I'm sure we'll talk about that on the show. If you've got questions, you can email us at questions@inthemoneypod.com, or find us anywhere on social media at In the Money Pod, and we'll see you on the next episode.